So thank you, everybody. We're going to go ahead and get started again. Thank you for those of you who came back on time. Our next panel is called Finding Alpha When Everything is AI. And this discussion will be led by Francisco Mariscal, who is the VP of Angeles Ventures, who brings deep insight at the intersection of technology, strategy, and leadership. Francisco will help us unpack what it truly means to find alpha when AI is everywhere. Please join me in introducing Francisco.
Thank you, Terry. And thank you, everyone, for joining us, our panel. And my name is Francisco Mariscal. I am a Vice President at Angeles Ventures, that is the venture arm of Angeles Investors. And I'm here with big news. Probably you heard those news yesterday. We officially did the final closing of our venture fund, Fund 1, of $20 million. We oversubscribed that fund. And we want to thank all the investors that are here in the room. You were a very important part of it, and as well as and in a summary, we have invested in 9 companies so far. 4 of them are marked up, but more important than that is that 3 of them are co-investments between Angeles Investors and Angeles Ventures, and that showcases the synergies between the 2 groups. So regarding the panel of today, is titled the VC Investment Trends for 2026, Finding Alpha Where Everything is AI. In terms of agenda, we'll start with brief introductions, move to the investment landscape, the AI investment landscape, then explore the capital deployment trends, and if time allows, I want to finish with a Q&A. So to begin with the introductions, I want to introduce Stephanie Perez. Stephanie is an investor and partner at Fin Capital. She mainly focuses in financial services and fintech, and also she has invested across multiple cycles. So I want to welcome her and ask if you can share a little bit more about your background, how you became an investor, and what you do at Fin Capital.
Yeah, for sure. So just for context on Fin Capital, we've been around since 2018. We have about 120 portfolio companies, and we do invest from pre-seed to growth. We do that through a variety of different vehicles, and we cover 8 different subsectors within fintech, the majority of our coverage being in the US. I actually have a pretty interesting kind of background prior to coming to Fin. We mostly hire folks that have fintech operating experience. We're very hands-on. We have a lot of board seats, and so we tend to really over-index on all things kind of business development and corporate development for our portfolio companies, and that happens to be my background. And so prior to this, I was in corporate development roles at MasterCard and Verifone and JP Morgan, and so the idea is to bring a lot of that go-to-market and growth execution to our portfolio companies, and so it's been a really interesting transition from being on the side of being a vendor and a partner to actually investing in some of these companies. So,
thank you for joining us today, and great experience. Next, I want to introduce Ariel Jadus. He's a general partner at Brainstorm Ventures. He focuses in early stage investments, specifically in AI and deep tech. So welcome, Ariel. I want to also, if you can share a little bit more about your background and what you do at Brainstorm Ventures.
Great. Yeah, and it's good to see some familiar faces and some friends, and thank you for having us today. So yeah, my name is Ariel. I run Brainstorm Ventures. We are a small industry agnostic and very early stage venture capital firm. We're finishing up investing out of Fund 3 and transitioning very in short order into Fund 4. I have a little bit of a random background, as a lot of VCs tend to have. Worked in Silicon Valley at Intel for a number of years, back when Intel was a more exciting company than it is now. I worked in strategy consulting for a couple of years. I worked for the UN in Venezuela. And then I worked at one of the pioneering impact investment firms back in the day when impact investing was becoming a thing.
Hello.
Thank you, Ariel. Also, great background and a little bit more different in the early stage days, so I love it. And then, last but not least, we have Claudia Duran. She is a managing director at Endeavor Miami, and she works very closely with founders that are scaling globally. So she brings another type of expertise. Claudia, please share a little bit more about yourself and about Endeavor.
Hello. Thank you for the invitation. So my background is finance, and I worked in the corporate sector for 8 years and then transitioned to support entrepreneurs out of Brazil at an organization called Ashoka, and been almost 7 years now in Miami at Endeavor. So both of my parents are entrepreneurs. I've always been passionate about entrepreneurs, I guess, and understanding, what are their pain points. And it's, I guess, in my DNA. So I've been supporting founders for 14 years now. And what Endeavor does is we're a global network of high-impact entrepreneurs. So we focus more on growth companies. And we look at founders that are, have big ideas, disrupting industries across. We're industry agnostic, but we do look at high growth. And so we're constantly doing due diligence and research in different markets across 50 countries where we have offices, just to find those, hopefully, high growth or sometimes unicorns. We have over 80 unicorns in our global portfolio currently. And we are an interesting organization because we're a hybrid. We are a nonprofit that focuses on selecting the founders. And then we have our fund that is a rule-based fund, and it only invests in Endeavor entrepreneurs once they're approved and accepted into the network. And the differentiator is that it's a financial sustainability model because 50% of the carry goes back to Endeavor to support the local offices that selected the entrepreneurs. So it's about $2 or $3 million tickets that we put in founders, and we have about 500 million in assets under management, and next month we're closing our fifth fund that's 300 million, and we're almost there. So yeah,
that's great. Congratulations. And as you see, we have 3 incredible professionals here in the panel, and they will add a ton of value and insights about the investment trends that are happening today. And to start, to begin the panel, a little bit about the big picture. As you have heard during the sessions of today, every sector is disrupted or embedded by AI. And in fact, PitchBook, that is one of our sponsors, just posted that software as a service is dead, and 2026 will mark what will be known as an enterprise AI supercycle. So with that in mind, I have a question for myself as an investor. It's like, if everything is AI, how I find differentiation, how I find returns. So with that in mind, I have my first question to Stephanie. Stephanie, how your lens has changed in the last years when thinking about AI, when thinking about differentiation, go-to-market strategy, time to market?
Yeah, for sure. So just in terms of the categories that we look at, we haven't invested in any LLM models, but we do find areas like orchestration and applications to be quite interesting. I think 2 areas that I've spent a lot of time kind of iterating my thesis on is around AI native apps. And what I mean by that is, and I would say most of our portfolio companies are now bolting on some sort of element of AI for some sort of process efficiency or some natural language interface. But what I would say is these AI native apps are dynamic in nature, they have probabilistic outcomes, and so rather than just computing for something, it's actually reasoning to be able to achieve that, and it gets smarter over time. And so we recently invested in a company in the customer service space, specifically for banks and insurance companies, and the premise there versus choosing something that was a bit more horizontal is that tonality is very important, and it's also highly regulated industries, right? So even mentioning certain APRs in your credit card transactions and the like need to be kind of regulated in terms of the type of messaging and tonality that needs to be used with the customer. So that's kind of an example of these kind of AI native apps from inception. And then in terms of agentic security, it's an area where we've not made an investment just yet, but we're doing a lot of diligence. And today, the current security frameworks are static. They're not for AI agents, right, that are extremely dynamic. And so it's not just about permissioning an entity. It's about knowing when, for what, and how, just because there's effectively a chain of different events that can happen that are triggered by these AI agents. And so those are two kind of the areas that we find to be really exciting and kind of white spaces for us.
I love it because I can conclude three things. First, go to market, having a niche. Second, differentiation. And third, data mode. And Ariel, I don't know if you agree with that, and if you are focusing one of those three things, or also you consider more things when you invest.
No, I mean, at the stage at which we're investing, founders still comes first and foremost. Nothing has changed there. In terms of differentiation, not as a firm, you mean of the companies that we're looking at? Yeah, I mean, I think go-to-market's really important. Like having a go-to-market strategy that works. I think the other thing that's important is with data moats, they're getting increasingly difficult. So I think companies that are inherently compounding data and compounding the benefit of that data, that's very important. Versus companies that have they have access to certain data sets that's potentially static, or they're partnering with third parties to have access to data. That kind of rings hollow. I don't think there's long-term value there. So what's important are companies that on the data side that inherent in their model, they're learning new data that's not publicly available, and their product is getting that much better on a real-time or weekly basis based on the data moat that they have. So yeah, I mean, I think those are two important areas of differentiation. In terms of returns, I think it's still a kind of power law space. I think venture is a power law industry. Nothing's changed there. As you guys have probably seen, I mean, I think the one big change in this AI era is really around watching companies scale at rates that we haven't really seen before, and doing so with capital efficiency and employee efficiency that we haven't seen before. Where you're seeing companies getting into the 8 digits of annualized revenue with 7 digits of capital raised, which you hadn't really seen before. So I think that part's unique, but I think the kind of structure of the industry is still kind of...
The change in the time to market has been incredible. And you mentioned another thing about founders, and that you bet in founders. And I have Claudia here, that she has a network of founders. And I want to ask Claudia, what are the type of founders are you looking for? There are two trends right now, the AI native builders and the industry experts. What are you leaning to, or what are you looking for in a founder?
We're looking for both. I think it's not healthy just to focus on one or the other. And for the AI natives, it's really exciting. We're seeing companies just scaling at a really fast velocity. Like you can check out 11 labs out of Poland, Runway out of New York. Actually, the founders are from Chile. And they're just, valuations are up there in the billions, but scaling really, really fast. And they're already, they were born as an AI company, already integrating all the efficiencies within their embedded workflows. But then you have the founders that, I'm just thinking of some that were in SaaS, and now they're quickly pivoting and adapting workflows so that they can catch up and incorporate more AI. And that means, reducing maybe the amount of people that they needed before in coding, and having more engineers. And now you can code really, really efficiently and in a shorter term. And this is just accelerating, right? So anyone now can just build a business, and we're going to see more competition. The market is going to be saturated. It's about the founder being able to execute efficiently. And that's where Endeavor focuses a lot, in helping the founder think through how can they scale the business. Because you can have an incredible idea or product, but if you don't know how to go to market, if you don't have a good sales team or marketing, if you don't know how to get to your customer, or be quick to have your feedback loops and then incorporate that, and how to read your data, then it's going to be hard to really scale.
I agree. And you touch another thing that I want to elaborate on, valuations, capital deployment trends. And I have my next question to Stephanie about how has changed the capital deployment, the pace, the valuations, and the traction of threshold between 2024 and 2025, and what are you expecting for this 2026?
So I actually think seed rounds are pretty frothy, just in terms of valuations for companies that are pitching themselves as like AI first. The rounds are moving very quickly. They're very kind of insider driven. And so what I think ends up happening is that money is flowing to many of the same companies, and so there ends up being a very big delta between what are perceived as the early winners and everyone else. And then in terms of companies that are maturing to like a Series A, in terms of the metrics, because growth in terms of revenue is unlike anything that we've probably ever seen before. There's now a question around repeatability and retention. That's probably a lot earlier than we would have been, asking about. So those are kind of two different ways in which we're thinking about it, at least on the early stage side.
I like that, especially the repeatability and the traction. And that's my question to Ariel, that he invests probably without traction, with a pitch deck. What have you seen with those founders getting into the levels of traction? They right now, investors are asking for more traction, and what do you think there?
Yeah, I mean, to that point, I do think that sometimes we invest pre-product, sometimes we invest pre-revenue, sometimes we invest when there's like super early revenue. I do think that that venture capitalists and angel investors ought to have a much like finer tooth combed looking at that revenue than they would have had a few years ago. A lot of this revenue is quote unquote slippery, right? It's revenue in something that's low switching costs. It's highly easily to replicate. So you take that revenue with a grain of salt. At the stage at which we invest, we have it like at the kind of pre-seed, which is most of when we invest. There hasn't been as much valuation appreciation as in the other rounds, but we've modified our strategy slightly in anticipation of future rounds either not happening or happening much later because these companies are more capital efficient, or happening but at crazy, insane valuations. So we've allocated a higher percentage of our capital to those upfront pre-seed investments to try to secure as much ownership stake as possible, and are kind of less dependent on our legacy follow-on strategy, because it's harder to predict right now.
Harder to predict, and they require more traction that sometimes it takes a while. And I like the thing, like what you mentioned about ownership, that especially in the pre-seed, that it's difficult then to keep the pace of following on in those deals. And then my last question is to Claudia. It's about more the founder lens towards the capital deployment. Is what are the founders are underestimating when going into a fundraising round?
A lot of things, I think. They first underestimate how hard it is to get your first check. And so we constantly tell them, don't give up. And investors are becoming more savvy on how to, deploy their capital. So what has been said here is really important. The revenue, is not just about showing that you have some revenues. Is this real revenue, recurring revenue? What are the switching costs? What's your churn? So for me, they underestimate the power of knowing their unit economics. And so for you guys that are constantly talking to entrepreneurs, make sure that they know their math, right? And if they don't, the founders, then they have to have someone in their team that is able to analyze the data, know their, what's their CAC, their LTV, all of these metrics, to make sure that the CEO and the C-level is knowing what direction the company is going to take, right, to make those quick decisions. And I've had so many founders that because they don't have the right CFO and the right team that know how to analyze this data and these metrics, they fall into very dangerous zones because they're not making quick decisions on how to pivot on time or how to make those iterations. And they spend a lot of time maybe on the wrong product, and then suddenly there's a aha moment that they have product market fit with something that they were not focusing on. So listening to the customer, they really underestimate the customer something. Those feedback loops and really understanding what the customer wants, it's super valuable. I really value founders that are out there talking to their customers, really listening and then incorporating that back into the business. Because if you don't understand what your customer wants, you can be selling a magnificent product and service, but if nobody wants it, then the company is not going to scale. So the power of execution, of really and being vulnerable and authentic as an entrepreneur is really important. If I'm not a subject matter expert, I need to have someone in my team that is. because then I'm going to have those conversations with investors and be able to answer, right, and have the knowledge.
I like that, to have complementary skills in the founding team. And how many people here are founders? Raise your hand. So right now I want to open it to Q&A, so you can do good questions back to the investors in the room and about the traction and about the numbers that you need. So who here has like any questions? John.
Hi, my name is John Canella. I currently work at Google within the cybersecurity team. One of the things I think about as you guys were talking was unconscious biases. I think like when one particular startup does well, maybe as an investor you might think, well, if they were to start another company, let me invest in them because they succeeded once, maybe they'll succeed again. I'm kind of curious on what your thoughts are on unconscious biases that maybe founders have about, in general, their capabilities, or unconscious biases as investors when we're actually investing in companies.
We tend to only invest in repeat founders, and the reason why is mostly because most of our portfolio companies are selling into banks, asset managers, and insurance companies that are highly regulated. Increasingly, there is exception to that with cyber, for example. If the CISO network is a very small one, and so if you've been a CISO at a large corporate and you have a stellar salesperson come along with you on the journey, then like that is a very attractive founding team. Likewise, if you have a more kind of product-focused offering, if you were early Stripe or early Plaid, that's also very compelling too, right? And so the narrative kind of changes. So I would say there is data to back up the success rate of previous founders, but another kind of thing that I think we all are guilty of is a little bit of herd mentality. So we often chase many of the same deals, and candidly, a deal is only as good as you're willing to pay for it, right? And if everyone ascribes a particular price to it, then that's the price. We're price takers sometimes as well, versus price setters. So there is this kind of inherent bias from that perspective, which is why it's really important to, as VCs, to develop friendships and collaboration with other investors that you trust, that you think are very smart, whose thesis you're aligned with, so that you can kind of come along the journey and truly know that whatever companies they've vetted are aligned with your goals as well.
Very good question and very good answer. Do you want to add anything?
Oh,
else?
yeah, I was just going to add, so yeah, to your point, I mean, I think a repeat founder who's had some level of success in their prior company is actually like a conscious bias. Subconscious biases that I think probably all fight against are, oh, this person, they're showing all of these traits that we love, they're doing all the right things, but they went to school X instead of school Y. Those are types of biases that I think it's important for for investors to get over and quickly. But being a repeat founder, to me, that's valuable, and we'll admit it that we're more likely to invest. If there's two founders that are the same, one's had success before and one hasn't, tackling the same problem, we're most likely going to go with the one that's had prior success. So.
Great, thank you, Ariel. Are there more questions here? Leaderman, here the mic.
Thank you for your time. Thank you for being here. Wonderful information. One issue that we have as Latinos, which I think is very well known here in the room, is that about only 2% of the funds come to Latinos. How can we solve that problem? Is it that we Latinos don't know how to ask for money, or do we need to be trained, or what is it, from your opinion?
I mean, I could start. It's hard. I mean, so I'm Latino. My partner at Brainstorm is Mexican American. He's Latino. We don't have, so some Latino owned or operated funds like Angeles, they have a specific mandate to back Latino founders. We've never had that. That being said, I mean, we've invested in the last year. We've invested in companies speaking of AI, at the model level layer that are Latino, at the infrastructure level that are Latino, at the physical infrastructure layer that are Latino. I think a disproportionate number of our founders in our portfolio are Latino because that's where part of our network, right? So I think that's part of it. I think having Latinos deploying capital to founders does slowly start to address the issue. But I think the more fundamental issue in terms of the capital stack is is at the institutional level, at the LP level. After George Floyd, as you guys know, there was like a lot of talk. So there was a lot of pools of corporate money that went towards Latino and Black-run venture capital firms. A lot of that's dried up, and it was kind of a drop in the bucket to begin with. So I think that's where a little bit of the larger challenge lies.
Yeah, I can add. Endeavor started in Latin America. We were bullish on emerging markets, and we went head on to LATAM first. And one of our first companies in our portfolio was Mercado Libre, then Globan. So we do have success stories from Latin American founders, and it was hard for them to raise capital back then. I do have seen a significant increase in investment going to Latin America. I mean, there's funds that only dedicate their funds to LATAM. What I do see is that there's not that much Latinos investing in Latinos. So I think we have to change that. I've been to many events in Latin American conferences where the families that are in Latin America that have that wealth that can invest in building real entrepreneurial ecosystems are not deploying the amount of money that is needed. So a lot of these founders are waiting for the American dollars to come in and invest in them, and some of them have to reallocate to the U.S. to be able to access those funding. So we have to change our own, way of seeing how can we help our region.
Very good question, Liederman. Do we have time for one more question, Teddy? Or
Yep.
yes?
Sure, yes.
Rafael?
Thank you, guys. So just a quick question. I've got a portfolio of investments, and one of them is looking at sort of native AI application, memory layer for robotics, so, longer term. And one of the decision points is, do you go after intellectual property protection or not, right? Models are moving very quickly. This is kind of aggregating 7 or 8 cutting-edge papers into something new. Do you go out and get clients, obviously making it public? Do you try to get some intellectual property kind of protection around it first?
We've done two, but we haven't gotten involved in their IP.
I don't know.
Too specific? Well,
I would seek counsel from a IP practice.
So as investors, do you care or not?
Okay, if it's, yeah, okay.
Do we do it or not? It's like when you guys are doing your deal review, do you say, hey, these people have, protection around the AP, so that makes it more likely to invest, or I don't really care, I want to see ARR?
No, you look at the IP and how, if you've developed that IP internally in-house or sometimes masquerading it and it's a third party that's created the technology and you're just repurposing it. So IP is very important. How you protect it, I mean, it's hard. Sometimes there's so much competition, right? You can just make a change and it's already a new IP. So it's about going to market with that, your intellectual property, it's yours, but it's how fast can you really build a business around it? Because you can have an excellent IP, but if you can't build a business, then it's not worth much.
Yeah, likewise, we'll do our IP checks whenever we do data room reviews and the like. It usually is for products that are much more technical in nature, candidly, which isn't always the case. Honestly, sometimes there are different wrappers around products to differentiate them, like distribution and the like. But yeah, it's part of our diligence process. Do you get extra brownie points for it? It honestly really depends on the type of product, but it is part of the diligence process.
Yeah, I was just going to say, generally, if it's like a bits company, like a software company, we don't pay as much attention to IP. But if it's an atoms company, which are less represented in our portfolio, in those cases, we care much more.
yeah. And
Like physical versus bits. Yeah, atoms versus bits. Yeah, sorry. Kind of nerdy.
was the toughest question of the day, that one. Yeah. And I want to add that, of course, it's in our due diligence process to see if there is IP and how defensible it is. But it's not the core, at least, of my investment. My investment is if they will be able to put a business behind that IP. And with that said, I want to wrap it up, this session. We had very incredible professionals here. So thank you very much, Stephanie, Ariel, and Claudia for participating. thank you all for being here. Great questions. And as a conclusion, if I have to have one key takeaway, is differentiation, data moat, and go-to-market strategy. So with that said, thank you very much for joining, and enjoy the rest of the summit and the networking.